Ted, thanks so much for joining the show.
Caroline, it's great to be with you. Thanks for having me, Bob.
All right, so I was just talking about the pretty impressive move that we're seeing, especially when it comes to the Dow and the Russell today, a continuation of last week's gains. What do you make of the momentum and the enthusiasm that we're seeing as we kick off a new week here on Wall Street?
I think it's really interesting because essentially we have all this capital post-election looking for higher and higher returns, right? We've seen the markets tick up. And I think it's really interesting is that we're seeing this dichotomy, not just in the equity markets, right? The Mag 7 has been cited again and again driving these returns, but we're also seeing the long-term credit markets demand higher interest as well. And I think that's because investors are assuming some inflation coming here, and all these economic policies potentially having inflationary effects on top of the fiscal policy that we're seeing as well.
Okay, so in terms of where this market can go from here, given the fact that if you take a look, the S&P 500 is now up 25% year to date, what are your thoughts around how much room there is to run for the equity market?
Great. Well, I think that the bump that we've seen, again, comes down to really two primary factors. What's happening in terms of the market anticipating new economic policy, and then second to that, what's happening with fiscal policy. Of course, the markets already seem to be pricing in what President-to-be Trump here has mentioned in terms of tax cuts, specifically around the corporate tax rate. He's promised rates around 15% coming down from where they sit today, over 20%. But in terms of where the market still has to run, I mean, it's hard to think that we're going to see lower financial market values in a lowering interest rate environment. And Jerome Powell, less reportedly, given the news around the election, but has promised essentially that we are moving into a lowering interest rate environment. Now, how quickly we get those cuts, we could talk about that. But ultimately, because of that, I think we do have room to run.
Well, the Fed has embarked on this lower interest rate, policy now with the Fed cuts that we've seen. But interestingly enough, we have seen this tick higher in the Treasury yield really since September. The 10-year yield is coming off a bit today. It's back below 4.3%. But overall, if you take a look at the chart, it's been on a path upward despite the fact that the Fed is cutting rates and is expected to potentially cut again in December. So what does that signal to you?
Well, I think that it signals that the market is assuming some rate of inflation. And so there's technical indicators that we could look at, and then we could look at the practical side as well. One of these technical indicators that I've had my eye on is essentially the spread between what the 10-year Treasury is paying, that risk-free rate that we always talk about, and the rate that we get on junk bonds as well as credit grade bonds. And that spread on the junk bonds is near a 17-year low, actually, and on credit bonds, a 26-year low. Again, telling me that I think the market's demanding a higher yield because it's going to assume some rate of inflation here. I think it might come because of the uncertainty around all the tariff, syntax and notes that Trump has made, and ultimately trying to figure out how much of that we're actually going to get. So again, a technical indicator of that spread. Now, on the practical side, I think what average Americans were anticipating was maybe trying to get some relief in terms of housing, and we just aren't seeing it. The Fed started cutting back in September. Today, three quarters of a percent now has been cut between then and today, despite across that same time frame, mortgage rates again sitting higher in that 7% range on a 30-year mortgage.
Okay, so what does all of this mean in terms of where you expect the Fed to go from here? Do you think that we'll see another rate cut come December? And then what about next year? Because that seems to be where a lot of the uncertainty is. And will that do the trick in terms of finally bringing mortgage rates down?
Good point.
Sure. I think that ultimately Jerome Powell is still looking at the data point around unemployment. And we did see some softening in the jobs numbers last week. And so I do anticipate he continues, this trend of interest rate decline. It's going to end up coming down to how much poor economic data we get. And sometimes that's an interesting balance, right? Poorer economic data basically meaning we're going to get lower unemployment rates, and that having at times really, of course, positive effects on the markets. But in terms of where the average American is sitting and what they can expect, if the job market continues to soften, I really think that Jerome Powell is going to see the analytical argument to continue these rate cuts.
Okay, so that's one mandate that the Fed has, maximum employment. Then also, obviously, it's to bring inflation back to the 2% target. We've been seeing some three handles when it comes to the core core CPI and PPI. We'll, of course, get the Fed's preferred inflation gauge, the PCE, later this week. If that comes in hotter than expected, could that potentially derail this rally? Because there's already some concern that maybe the Fed might have to pause come December.
Certainly. I think that if we are going to see hotter inflation, it's going to be an argument against these rate cuts. You'll probably see a lot of, if that does happen, I would expect Jerome Powell to kind of do some of the word salad that we've seen a lot the last several years of, we're keeping an eye on it and those types of things. Ultimately, retail sales are also going to be, I think, a big informant here. What are we going to see Americans do? Not just, in terms of the economic number coming out later this week, but also just across the holiday season. There'll probably be a little bit of a push. Americans have been very durable. We've been surprised to see this year. But is that, a moment in time, maybe for December, maybe we don't see a cut, perhaps, potentially. But it's hard for me to think we get into 2025 and that we don't still see a lowering cycle in general.
Yeah, it does.
That being said, and given the fact that people are looking for higher and higher returns, as you've said, and how high we've already seen the market go, where would you be comfortable putting money to work right now?
Well, we've seen the tailwind that the interest rate cuts have had on certainly those small cap positions. It's a nice place if we are going to enter that long-term lowering interest rate environment. That tends to be certainly a tailwind for those small caps. That paired with the fact that all of this discussion around tariffs tends to favor those companies that are more domestic in nature, more closer to home, a lot of those small caps as well. I think that that's a nice play as an alternative to what's been running, the markets up in big tech lately.
Okay. And finally, I do want to ask you about your book called Launch Your Retirement, a Financial Planning Guide to Go from Saver to Spender. And the title threw me off. In fact, I actually Googled it to make sure I had that right, because I thought the goal was being a saver, not a spender. So tell me why that's no longer the case.
Well, when you make the biggest transition of your financial life, going from your savings years into your retirement, into your spending years, that's really where you get that freedom to finally say yes. As we advise clients, I think oftentimes our job is to sometimes say no, put that extra money away, save, of course. But I think that the most rewarding moment we can have as advisors sometimes is getting to say yes, and that you've prepared yourself well. And making that transition and outlining the steps necessary has been something I've been really passionate about for a long time, and why I wrote the book.
Okay, so seeing as I'm a million years away from retirement, I still have to save at this point, and then I can spend a million years from now. That's what you're saying.
Hopefully not a million years from now, no. But yes, absolutely. I'm tracking with you.
All right, noted. I'll keep those carts, those items in my cart. Ted Thatcher, Bright Lake Wealth Management, thanks so much for sharing your insights.
Thank you.